You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, well, let's jump into last week's trade. On last week's trade, it wasn't necessarily a winner, but it's not necessarily a loser. So those are usually the ones that we can learn the best on. Obviously, when a trade goes up in value, it's pretty simple as to what to do. You can take a profit. You can try to ride it out a little bit. Those aren't usually very good learning experiences. But here on Options Playbook Radio, everything that we do is not meant to be a recommendation. We just kind of look at it as paper trades. So last week, we definitely did a speculative trade that doesn't really get talked a lot about options analysts. I think they get ignored almost too much. But the strategy that we looked at was a long straddle. And I'd mentioned that on Options Playbook Radio, even back before the pandemic, that there were a couple underlying stocks that a long straddle made sense in. And even since the pandemic, just the concept of buying premium as opposed to selling premium at the big downturn was actually a good strategy. Buyers overall should have did better than sellers, and that's basically because the actual volatility was higher than even what the marketplace was implying at the height of the pandemic. In other words, we're getting wilder swings, and they went in one direction. So if you got the direction right, you were better off buying options than you were selling them. So to keep that theme alive in this right now, in the most recent times, the last couple of weeks, the VIX index has stubbornly stayed above 25% volatility, which is abnormal to see when you're getting market highs to see the VIX stay that high. But there's still a lot of uncertainty. Obviously, we have the election coming up, and we still don't have a cure for that pandemic, for the COVID. So because of that, volatility has remained inflated. But yet the market recently hasn't really been very volatile. The actual volatility hasn't been as high. So with that said, I kind of wanted to talk a little bit about stocks that maybe you might want to think about long straddles on. We're coming into earnings. We're not quite there yet. And one of the industries that we talked about even doing long straddles on before the pandemic is the airline industry. And specifically, we talked about Boeing. Why? Because Boeing was in the news all over the place back then, and it was mainly because of their jet that they needed to get flying again, and all the headlines that were out about, will the MAX fly, will it not fly? And they were blindsiding the market, and Boeing was all over the place. So long straddles, I think we did quite a few of them, and I honestly don't think any of them were actually losing trades. Now, that doesn't mean the next one wouldn't be, but that's where we were at. So I'm going to go back to the wheelhouse. And we have a lot of airlines that were announcing earnings that are coming up shortly, but I really don't want to pay the premium for their earnings announcement. And that's one of the things that I feel with a long straddle is that you don't want to be in stocks where the earnings are known, because you're going to pay for that. You're going to pay that implied volatility because it's a known event. So now you're just guessing, will the marketplace get the implied volatility wrong? Will it be more than the expected move, or will it be less than the expected move? You're basically like betting the over-under on the final score of the football game. Will they score more points than the line, or will they score less points than the line? And it's all based off of that specific game. Well, this is based off of a specific event. And so when I'm looking at a long straddle, what I want to try to do is target stocks that may be in the news, that may have some headlines. And one of the biggest headlines that's going to just rock the entire market is if somebody comes out and says, oh, we have a cure for the coronavirus, we have a vaccine. How good is the cure? So with that in mind, I don't necessarily know when that could happen or how that news could happen. But overall, I think the industry that would be affected the most is obviously the travel, or one of the industries that would be affected the most would be the travel industry. Nobody really knows what's going to happen next. Even Warren Buffett got it wrong with Delta, added more shares of Delta around 40, ended up selling it somewhere in the 20s. I don't know exactly, and usually kind of hard to find the exact price that he actually sold it at. But overall, he still owns some Delta, still owns some airlines, but definitely cut back on all of his positions. Okay, so enough talk about last week's show. That was actually a very deep summary of it, probably more than we actually needed. But it was on October 7th. We looked at a long straddle. We did a very short-term long straddle because we wanted to avoid earnings, and earnings are coming. And the underlying stock was trading at 1765. The market was closed. We looked at doing the October 16th expiration, which is now just a few days away. But at that point in time, it had over 10 days to trade. And so we got 2 more days left in that underlying. And I should mention that we are taping Options Playbook Radio. It is October 14th. The markets are closed. And the stock closed at 1756. So it basically closed just about where we were at when we put the trade on. Now, since that time, the stock has been volatile. The stock actually ran up as high as 1818. That was the high point since we talked about this underlying. And that should have made the option profitable, but that means you would have had to hit it right on the top of the trade. In other words, you should have been able to sell both the call and the put for a profitable situation. But if I'm looking at a long straddle and I have I have a momentum in one direction, I want that direction to at least pay for my long straddle. And when we were talking about it on the show, I think the midpoint was somewhere, we'll call it 105, 110. I think I don't exactly know where it was when we talked about it, but let's call it 110. Okay, so $110 for every 1-by-1 straddle, plus commission to put on the trade. That would be your maximum risk. So we had risk kind of managed anyways, just because they were inexpensive option contracts overall. And that's part of the reason why we use the ETF with the symbol JETS, because in general, you usually don't have to pay. The volatility will be muted a little bit in an ETF. We still expected some volatility overall in the industry, but I didn't really want to have to pay up for an actual airline long straddle. Okay, so stock went up to 1818 at that point in time. If the call option was trading for around 110, you should have got out. You should have let that trade just right, because we had such a short-term look at that underlying. So I actually was able to get a quote based off of the close on Friday going into the weekend, and it was trading for 105. Now, with that said, knowing it was such a short-term trade and you'd only have 5 more trading days after Friday, if I could have got out at even on the trade, which actually the midpoint of the option contracts, the call was trading for 80, the put was trading for 25, so you could have got out at 105. But going into that close, I probably would have closed out that trade, mainly because I didn't want the time decay over the weekend, and we already had a situation where the market ran up and it didn't continue that momentum to the upside and make this trade real profitable, because there was obviously a point where it was profitable, but probably not by a ton. But I really don't mind if that underlying goes up and you're on the call side, you paid $1.10 for it. Think about getting out if you can make even a dime, and then you have a lottery ticket on the downside on a volatile underlying, and maybe that comes into play too. Then you can just let the second half ride. But it's all about the momentum and where you're at when you're doing the trade. Biggest thing is you got to have a plan. And to me, I would not have sold that call if it didn't get to $1.10. If it was 105, I would not do it. I would want to at least get my money back or make a profit on one side of this trade before I let the other trade ride. So going into Friday, if I would have been right around profitability or right around even on the trade, I would have just got out of it. It was a speculative trade overall. I am managing my risk by just using out of the money cheaper options in an ETF. But I would have just closed that trade on Friday and took a small loss. Looks like it would have been about a nickel on Friday, and just not let it ride into the weekend because we had to run up. The momentum didn't stay with it, came back off a little bit. Lucky enough, we were close to break even, close the trade and move on. There you go. So as I said, when you're talking about trades where they're just kind of profitable, those are the kind of the more interesting trades. One other small thing you could have done is you could have went a little bit out of the money and sold a call because it kind of went to the upside, and maybe sold a call a strike or two above and rolled this into a long call spread. Maybe you had a week remaining to expiration, would have been all about what that, well, the strike that we used was the 127. It closed at 810 or so. So you would have looked at the 20 or the 21 strike and seen what type of premium you could have got for 1 week. But more than likely, I would have just closed the trade and moved on and said, okay, I don't want the cheese anymore. Just let me out of the trap. Okay, let's look at this week. We have earnings coming. The trade that I would like to talk about is long calendar spreads. And once again, on Options Playbook Radio, it's not meant to be a recommendation, but we look more at what's the situation in the overall marketplace and what strategy may apply to that situation. And I mentioned at the top of the show that the VIX is still up around 25%. The markets were down a little bit today. And as long as that VIX stays high, that also means that across the board, you're going to see volatilities in just general stocks at an elevated rate too. Not necessarily because the historical volatility has been high. I mean, it's been in some underlyings, like obviously Tesla, implied volatility and historical volatility have both been crazy. But a lot of the underlyings, that uncertainty is still there, and that's keeping implied vols higher, but the historical isn't quite there. So with that said, going into earnings, what are your favorite stocks? We got the FANG stocks that are going to be announcing earnings here. We got Netflix kicking it off on the 20th. We got Amazon next on October 22nd. Then it looks like we have Microsoft, if you want to include them in the FANG equation, on the 27th. Then we have a big day on the 29th, which is a Thursday. We have Apple, Facebook, and Google all announcing on a Thursday. And I say that's important. Most of them are usually after the close with the FANG stocks, in that then you have 1 day to trade the weeklies. So they announce Thursday, the news comes out, and then by Friday, those option contracts need to go away. So that's always an interesting scenario when you're going to just trade a 1 day option contract. And in those underlying stocks, they're all expensive stocks. Apple is a little less expensive nowadays because of the split. But you have pumped up volatility in the marketplace. You have pumped up volatility because of the earnings report. And all those options that are out of the money have to go to zero, right, if they finish out of the money. Why? Because there's only 1 day left. So I always find those interesting scenarios. So here's what I'm going to look at, though, is let's look at a long call. And I'm going to pick Apple because it's the least expensive out of the three. Nothing's meant to be a recommendation, but it means that we can manage our risk because the least expensive stock will have the least expensive options on a relative basis. So if in the options world, if the underlying is lower priced, that means that your option contracts would be lower priced overall. And you can think of it, if you make the insurance analogy, is it going to cost you more to insure a Bentley or a Chevy Cavalier? right? The more expensive that asset, as far as your car insurance is concerned, the more expensive the insurance is going to be in general. And that's kind of the way to think of it in the options world. Doesn't matter if it's calls or if it's puts, it's still the same concept overall. All right, so on flip a coin, we're going to be bullish. Don't necessarily care if you want to be bearish. You take the same concepts and you would go to the bear side. And we're going to pull up an option chain. We have the markets are closed. It is the 14th of October. We are going to look at the 127 strike. Apple closed at 121.19. If I look at the long straddle for the 30th, which would contain earnings, like I said, Apple's going to announce on the 29th. So the 30th is that Friday after the market close. If we look at, that's 16 days away. And then we're going to go and sell the option contract. That is 9 days away. So the implied volatility on the expiration that contains earnings, the 127 strike, is at a 48% implied volatility. The shorter term strike that does not contain the earnings, that expiration October 23rd, is trading at 42% implied volatility. Now, when I'm doing time spreads or calendar spreads, the battle against volatility is always pretty big. So it's nice if you think going into earnings that the October 30th expiration may increase in implied volatility, which kind of makes sense, and the shorter term option contract may decrease or at least stay flat, then this is one way that we might be able to get into a long call at a lesser price overall to be bullish on Apple going into earnings. Or if you did it with puts, it would be to be bearish. Once again, not meant to be a recommendation, so I'll let you pick whatever direction that you really wanted. Now, I want to make sure that I'm not going too far out of the money. If I look at that long straddle price, we're going to call it close to $10. It's not an exact science. Maybe 970 or 960 is approximately what the midpoint would be, but we'll call it $10. So I want to make sure that the underlying stock can get there. $10 with the stock at 121 would be 131. So we're going to use the 127 strike. Why? Because that's a price where the market says, or the expected move going into earnings, it's a feasible price. It could get to 127 based off of where they're pricing the option contracts at. 131 would be a good move. Above that would be taking the over. Below that would be taking the under, if you will, to use betting terminology. All right, so speculative trade. We look at this option contract trading at 48% implied volatility, a little bit of juice, a little kind of juiced up, but it's a good market. It's 258, even with the markets closed by 267. Let's call it 260, okay, approximately, if we could fill somewhere around there. And we'd be paying 38% implied volatility. Now, if I just bought that option outright, I would be battling time decay and I'd be battling fluctuations in implied volatility as much as I am battling the direction on where Apple's going to go. So let's sell some of it. Why can we sell some of it? Because these option contracts are still juiced, because remember what I mentioned about the pandemic. And I'm getting a 127 strike that does not contain earnings trading at a 42% implied volatility. Right? That's still really high relative to where Apple was at before the pandemic, down around 20% implied volatility at that point in time. So this is why this strategy is interesting right now going into earnings, is that I can sell this and I can bring in $1.20 approximately on that 127 9-day to expiration October 23rd call option. Interesting, right? I'm taking a lot of that vol premium. I'm hoping the underlying goes up towards 127, another 6 or 7 points. And it would be nice if it would just slowly creep that way over the next 9 days. And then I could either sell my time spread if I wanted to, should be profitable if that happens. But if not, that short-term option expires and I get into a long call option at a relatively cheap price going into that earnings, and that's kind of the goal here. So if I do this strategy, let's actually give you everything. We'll go through the complete steps as to enter as if you were entering the time spread. So we are taping Options Playbook Radio. I'll say it one more time. On the 14th of October, the markets are closed. Apple closed today up 9 cents at 121.19. We are looking to buy the October 30th expiration, 127 strike call, and at the same time sell the October 23rd expiration, 127 strike call. The midpoint, according to my after-hours chains, is trading for $1.45. That means our total risk on this trade is $145 all the way up to that first expiration date. And then after that date, it's really how you end up finishing your trade overall. If we did this, our view would be that we'd like Apple to slowly run up to 127 before that first expiration. If it gets to 127, I'm just going to close out this trade. I will be a little bit profitable, not a lot profitable. I'll have a small profit on this position in theory. It's hard to say exactly how profitable it would be, and mainly because you're dealing with two different expirations. You need to know what the implied volatility will be for the near term and the far term to try to make a guesstimate as to what these prices of these option contracts would be. So if it gets to 127, I'm going to get out because I don't want the risk of the trade. If it doesn't, I might just ride the long call. If it goes down, well, that short-term option contract should expire worthless. And once again, you can decide, should I sell my longer option and just say, okay, I don't want the cheese anymore, let me out of the trap like we did on the long straddle, or do I let it ride going into earnings? This obviously earnings are going to be very interesting, and they have been ever since the pandemic is announced, let alone they have been just in general in the FANG stocks overall. Stocks have made big swings in this FANG index, if you will. All right, well, that's going to be it for this episode of Options Playbook Radio. I have a big event that I want to tell you about. It's called the Ally Future of Investing Digital Conference. You can get to it by going to ally.com/future of investing. And when you go there, you will be able to register for our event. It will be on our YouTube channel, which also means that the simplest thing to do is to just go to youtube.com/ally, ALLY, and you can find it there, and you can sign up on our YouTube channel, or you can go to the registration page, sign up, and we'll send you reminders for the event. It will be an all-day event, and I will obviously be speaking at it, and so it'd be great to see you there. If you have any questions, you can email me at theoptionsguy@invest.ally.com. Please follow me on Twitter. My handle is @BrianOverby. And until the next time, may all the options that you bought finish in the money, and all the ones you've sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.